Hi guys, this is CA Balakrishna from Lecturepedia.in. How are you? Hope you people are doing well. Even I am fantastic. Now in the today's class we will be revising audit of banks, revision of other chapters. Most of the chapters revision it is done. You can find it in the playlist, and this handwritten chart you can get it from our Telegram channel, and the link for Telegram channel I will be giving it in the description. Okay. Now before starting the revision, this audit of banks is somewhat lengthy chapter when compared to other chapters, but the weightage of this chapter is just 4 to 5 marks. Considering this, it is suggestible to go through this chapter at end of all the chapters. After completing all the chapters, you revise this chapter. Okay. So now coming to the revision part. First of all, if you see, the business of banking is somewhat different when compared to other types of business. So there are special characteristics of this banking business which will warrant the need for special consideration while auditing these banks. So what are those characteristics of banking business that will warrant the consideration of special aspects? Firstly, nature of risk that is associated with the banking business. Generally in the banks you will be dealing with cash. If cash is present means the risk is very high. So the nature of risk associated with banking business is somewhat higher when compared to other businesses, and also the scale of operations of this banking business is also very huge. They will be having a lot of branches, and the adoption of information technology in the banking is also at very high level when compared to other types of businesses, and there are various statutory laws and regulations that will be applicable on the banking businesses. We will be seeing what are the laws and regulations that are applicable to banking companies, and also there will be continuous developments of new products in case of a banking business. Due to all these factors, special consideration has to be given while conducting audit of a banking company. Now, what are the various laws and regulations that are applicable for a banking company? If you see, first of all, we have Banking Regulation Act, then RBI Act, Companies Act, RRB Act, Regional Rural Banks Act, Information Technology Act, PMLA, Prevention of Money Laundering Act, SURFACE, Payments and Settlement System Act, Cooperative Societies Act, SEBI regulation in case of listed bank. These are various laws that are applicable on a banking company. Now even a banking company has to prepare its financial statements. For preparation of financial statements of a banking company, Schedule 3 is applicable. Schedule 3 of not Companies Act, Banking Regulation Act. Okay, here also we are having Schedule 3 in the Banking Regulation Act, which deals with the format of financial statements of a banking company. Now balance sheet will be as per Form A, profit and loss will be as per Form B, and even banking company has to comply with the disclosures that are required under section 133 of the Companies Act 2013, and for banking companies Ind AS is mandatory. Actually the applicability of Ind AS was deferred to financial year 21-22, but from this financial year for all the banking companies Ind AS is applicable. And coming to appointment of auditors, in case of nationalized bank, auditors will be appointed by board of directors of that particular bank, and in case of other banks, the shareholders, that is members, will appoint the auditor in the annual general meeting. However, in case of these both banks, the appointment of auditor has to be approved by RBI. Okay, and coming to SBI, State Bank of India. In case of State Bank of India, auditor will be appointed by Comptroller and Auditor General in consultation with the central government. And coming to regional rural banks, in case of regional rural banks, the auditor will be appointed by the concerned bank itself with the consultation of central government. Okay, with the approval of central government. This is regarding appointment of auditor of various types of banks. And coming to stages of bank audit. This question, it is not so important, you can just go through the side headings. Basically we will be having 5 stages in the bank audit. First stage is initial considerations. What are the aspects that will be forming part of these initial considerations? First of all, acceptance, then declaration of indebtedness. Generally auditor should not have any debt due to the banking company. So before appointing a person as the auditor, that particular person has to give a declaration stating that I am not due any amount to the bank. Like this, a declaration of indebtedness has to be submitted. And internal assignments, the statutory auditor should not have taken up any internal assignments in that particular bank, like concurrent audit, stock audit. Those types of internal assignments should not have been taken up by the statutory auditor. Even that declaration has to be given. And terms of engagement will be discussed, and communication with the previous auditor. The current auditor, he has to communicate with the previous auditor. And planning and engagement team. These aspects will be considered in the initial consideration stage. After that, understanding. What will be understood? First of all, the banking business will be understood and its IT environment will be understood. Then what are the internal controls that have been implemented within the bank? Internal controls will be understood. Then what is the accounting process that is being followed by the bank? Accounting process. Then what is the risk management process that the bank is following? These 4 aspects has to be understood by the auditor. Next, coming to risk assessment. Here what the auditor will do? He will first of all identify and assess the risk of material misstatement in the bank. Identify and assess risk of material misstatement in the bank. And in case of banks, there is a chance of money laundering taking place. So auditor will identify whether there is any risk of money laundering in that particular bank. Okay, risk of fraud including money laundering. And he will also assess specific risk, like in case of banks, information technology will be widely used. So is there any risk with respect to information technology? Like this, specific risk will be assessed by the auditor. And finally, risk associated with outsourcing activities. These risks will be assessed by the auditor. And then coming to execution stage. In this execution stage, he will discuss with the engagement team, he will respond to the assessed risks, and he will determine audit materiality, and he will also consider the going concern of the bank. Finally, he will report. In case of reporting, there are various types of reports and certificates that the auditor will give, that we will see at the end of the chapter. Okay, at the end of the chapter we are having a particular question which deals with the types of reports and certificates that the auditor will issue. That we will see later on. And coming to the internal controls. Now here, internal controls with respect to various items has been given. Okay, what are the specific internal controls that has to be implemented with respect to specific items, that we will be discussing. Before discussing that, we will see general controls that should be present in the bank. What are the general controls that should be present? First of all, the staff must be shifted their positions without any prior notice. Okay, shift the staff positions without any prior notice. And there should also be a maker checker concept in the internal controls itself. The maker checker concept should be inbuilt, like the work that is done by one staff member should be automatically verified by another staff member. Such type of system must be present. Maker checker concept. And at the end of the day, the entire transactions relating to the bank should be properly tallied. Okay, without tallying the transactions that has taken place during the year, none of the staff will be allowed to leave the bank. Okay, so prove arithmetical accuracy of books of accounts every day. Okay, each day, at the end of the day, the arithmetical accuracy of the books has to be proved. The books has to be tallied. And all bank forms should be in possession of one particular officer, and mail should be opened only by the responsible officer. The access to the mail should be only with the responsible officer. Hope this is clear. and there should be clear differentiation between financial powers of various staff in the bank, and there should be periodic surprise inspection of head office as well as branch offices. Who will conduct these periodic surprise investigations? Generally the internal audit team of the bank, they will conduct this surprise inspections of the head office as well as branches. So these should be the general internal controls that should be present in the bank. Now coming to the specific internal controls in respect to various items. First one is cash. First of all, cash should be in the joint custody of 2 or more officers. Okay, joint custody of 2 or more officers, and this cash has to be test checked by some other officer daily, and occasionally the cash should be completely checked by some other officer other than the officer who is handling the cash. Daily test cash and occasionally full counting by other officer, and also no access to the cashier has to be given to the customer ledger. The cashier, the person who is handling the cash, should not be allowed to make or to alter entries in the customer's ledger account. This should be another internal control that has to be present in the bank. And also the payment to the customer has to be made only after entry is passed in the books of accounts. See, make payment only after authorization and entry in the customer's account. Whenever customer comes to withdraw the amount has to be paid to him only after authorization and entry is made in the books of accounts. And then compare receipt and payment scrolls with the cash column of the day book. You have to compare the totals of receipt book, payments book with the total of cash column that is present in the day book. Both should tally. And high value cash transactions to be verified by a higher officer or manager of the bank. And finally, remit excess cash to the currency chest. Generally, bank branch will be allowed to maintain only certain amount of cash. The cash in excess of such limit has to be sent to the currency chest at the end of the day. Hope this is clear. So these are the internal controls that has to be present with respect to cash. Next, check clearing. See, whenever bank receives a check for an amount of 5 lakh or more, then it has to make a communication to the customer either by call or through mail stating that we have received a check in order to make a payment from your account. Whether this check of 5 lakh or more has been actually given by you or not, like this a confirmation has to be taken from the customer. Okay, see, call or email the customer if the check received for 5 lakh and above. The auditor shall test check whether that procedure is actually being followed in the bank or not. And the bank staff should also check whether the signature that is present on the check is matching with the signature of the customer. Okay, from the specimen signature book that the bank will be maintaining, it has to tally the signature that is present on the check. And finally, in case there are any unpaid checks, they has to be sent back to the customer or should be informed to the customer stating that this check has been unpaid, you please come and collect the check. These are the 3 internal controls related to checks. And coming to bills for collection, I hope you know the concept of bills for collection. Generally, whenever a supplier sells goods to the customer on a credit basis, then the amount will be collected from the customer after the credit period, let's say 10 days. Now, in order to collect this bill from the customer, the supplier will assign these bills to the bank. He will ask the bank to please collect these bills from the customer on my behalf. For this service, the bank will charge a certain commission. This is the concept of bills for collection. Now, what are the internal controls related to this bills for collection? Whenever bank receives these bills for collection from the supplier, along with these bills, the relevant documents should also be received from the supplier. And what are the documents that have been received? It has to be noted down in the register. All relevant documents to be received and enter in the register. And credit should be given to the customer's account only after the bill has been actually collected. Without collecting the bill, you should not credit the customer's account. Credit the customer's account only after bill have been collected, and ensure that there is no dual entry for the bills sent from the one branch to another. Generally, sometimes what happens is, let's say this is branch 1, this is branch 2. Now, branch 1 is, let's say, in Kurnool, and branch 2 is, let's say, in Chennai. Now, Kurnool branch has received a bill for collection, and that particular customer from whom the bill has to be collected, he is present in the Chennai. So what this Kurnool branch it will do? It will send this check to Chennai branch stating to collect the bill. Now this check will be recorded as, this bill will be recorded as outward bill for collection by branch 1, and the same bill will be recorded as inward bill for collection by branch 2. Now, two entries are made here. While consolidating the financials, you should take care that these dual entries are not present. Only one entry should be present in the books of accounts. Hope this is clear. Next, bills purchased. Sometimes what happens is, instead of taking bills for collection, the bank will purchase the bills from that particular respective supplier. Let's say the value of the bill is some 1 lakh rupees, and the supplier is in need of money, urgently he needs money. So what the bank will do, bill amount is 1 lakh na, I will give you 97,000, you sell that bill to me. Bank will purchase the bill, and on the due date, bank will collect 1 lakh rupees from the respective person from whom the bill has to be collected. So like this, the bill purchase will give a commission of 3,000 rupees to the bank. So bills purchased. In this regard, what should be the internal controls? Officer has to verify that title documents are assigned to the bank. Once the bills has been purchased by the bank, the respective title documents should also be assigned to the bank. In case there is any security that is offered against that bill, even that security has to be transferred into the name of the bank, and sufficient margin or discount should be kept by the bank. Okay, the margin or discount that is kept by the bank should be sufficient and reasonable. If the bank fails to collect on due date, then it has to immediately take the steps to recover the amount by selling the security, or by asking the supplier to give the amount. So the recovery steps has to be taken immediately, and report irregular outstanding accounts to the head office. And finally, for bills outstanding at the close of the year, proper accounting regarding the commission has to be made. If a bill is outstanding as on 31st March, then the commission that the bank will earn on that particular bill will have to be bifurcated between 2 years. Okay, based on the period that is falling in each year. So that bifurcation has to be made properly. This is regarding bills purchased. And coming to loans and advances. What are the internal controls that should be present with respect to loans and advances? Whenever bank is giving a loan to the customer, it has to properly check the credit worthiness of the customer. Okay, credit worthiness of the borrower. And while granting the loan, all the relevant documents has to be properly executed by the bank. Execute all necessary documents, and there should also be sufficient margin that has to be kept against the security. Let's say bank is giving a term loan of 1 crore rupees. Against this, it is getting a security of land. Let's say the value of the land is some 2 crores. Now for this 2 crore value of land, it should not give entire 2 crore as loan. It should have to keep sufficient margin. Okay, let's say it wants to keep a margin of around 20%, then it can give 1.6 crore as loan. So such sufficient margin has to be kept by the bank before giving the loan, and securities must be held in the joint custody of 2 or more officers and register security in the bank's name. The security that is offered to the bank has to be registered in the bank name only. All accounts to be within the drawing power and sanctioned limit. Generally this point it will be applicable for working capital loans, CCs and ODs. Okay, at all the time the amount of CC or OD, it should be within the drawing power or within the sanctioned limit that is allowed to the customer. Okay, sanction limit it will be fixed, drawing power it keeps on changing based on the security, okay, based on the stock statements that the borrower presents to the bank. So at all the time the amount outstanding in the account should be less than drawing power and the sanctioned amount. However, the bank can temporarily extend a loan, a ad hoc loan of 20% of the original amount up to a period of 90 days. Hope this is clear. Let's say bank has originally granted a loan of 1 crore rupees, and due to some reason the customer he was not able to present the stock statement for that respective period, and he wanted some extension of the loan amount. In this case, even though stock statement is not given by the borrower, an amount of up to 20% of the existing amount, that means 1 crore plus 20 lakhs can be given for a maximum period of up to 90 days. This is ad hoc sanction of loan. Okay, next, irregular accounts to be brought to the notice of head office. In case there are any irregular accounts, they must be brought to the notice of head office, and review operation in each advance account at least once in a year. These are the internal controls that has to be present in the loans and advances. Coming to the credit card operations, even in credit card operations also, whenever you are giving a credit card to the customer, you have to check his credit worthiness. Okay, and you should also effectively screen the application of the customer. And the credit cards, the stock of credit cards must be kept in the custody of the responsible officer. Okay, control over the storage and issue of the cards. And merchant confirms unutilized limit of card before accepting the payment. Merchant, whenever he is accepting payment from the customer through the credit card, first of all he should confirm the limit that is available to that particular customer before accepting the payment. Actually nowadays this process it will take automatically through this mission, POS mission, it takes care automatically. Next, prompt reporting by merchants of all the settlements accepted through the cards. Okay, at the end of the day, all the payments that has been accepted through the cards, through the credit cards, has to be reported to the bank. And merchants will be reimbursed only after verification of the card acceptance by the merchant. Okay, bank before reimbursing the amount to the merchants, it will have to verify whether that particular merchant has actually accepted the card while accepting the payment. Next, immediately charge to the customer's account. Once the amount has been reimbursed to the merchant, that amount has to be charged to the account of the customer, okay, the credit card holder. And statements, the credit card statements should be sent regularly to the customer. These are some of the controls with regard to credit card operations. Coming to the CRR and SLR, cash reserve ratio, statutory liquidity ratio. Generally in order to maintain liquidity in the banks. If banks give entire amount of deposits that they have accepted as loans, there will be shortage of liquidity in the bank. So in order to maintain liquidity, RBI has prescribed this CRR, cash reserve ratio, and SLR, statutory liquidity ratio. Generally every bank, it has to maintain 4.5% of its net time and demand liabilities as cash reserve ratio. How it has to maintain? It has to maintain either in the form of cash or as deposits with Reserve Bank of India. Okay, in case of CRR, either cash or deposits with RBI. Percentage is 4.5% of demand and time liabilities. Coming to SLR. SLR is generally, it is 18% of demand and time liabilities. It has to be maintained in the form of cash or deposits with RBI or any approved securities, government approved securities. In these three forms of investments, bank can maintain its statutory liquidity ratio. Generally this SLR and CRR, it has to be seen bank wise. Okay, overall bank wise, not branch wise. Hope this is clear. Generally each branch, they will submit their trial balances as on last Friday of second preceding fortnight. On this day, all the branches, they will submit their trial balances to the head office. Now head office, it will consolidate all the trial balances and it will determine the amount of demand and time liabilities as on the last Friday of second preceding fortnight, and that on that demand and time liabilities, 4.5% has to be maintained as CRR and 18% has to be maintained as SLR. Hope this is clear. Now, while performing the audit, what the central statutory auditor, what he will do is, he will verify SLR requirement at 12 odd dates of a fiscal year, not being Friday of entire year. He will pick up 12 dates. Okay, not being Fridays, because Fridays will be reporting, in the Fridays there might be reporting Fridays. So except Fridays, from the other days he has to pick up 12 dates, and on those 12 dates he will examine whether the requirement of SLR has been satisfied by the bank or not. Coming to the audit approach regarding CRR and SLR. First of all, what the auditor has to do is, he has to obtain understanding of the circulars that has been issued by the RBI. Generally what the RBI will do is, it will issue circulars giving guidance on how to calculate demand and time liabilities. So this calculation circulars has to be understood by the auditor. Understand the RBI circulars regarding the demand and time liabilities. Next, examine the demand time liability position based on consolidation of branch trial balances. I have told you now, branches will send their trial balances to the head office and head office will consolidate the trial balance. Now there are certain items that has to be excluded while calculating demand and time liabilities. What are those items? There are 5 items. First of all, paid up share capital, reserves and loans that have been taken from Reserve Bank of India, Exim Bank, NHB, National Housing Board, and SIDBI and NABARD. All these, they have to be excluded while calculating demand and time liabilities. Second item, amount of recoveries. Okay, part amount of recoveries from doubtful and bad debts, even that has to be excluded while calculating net demand and time liabilities. Amount received in INR against import bills held in sundry deposits pending receipt of final rates. Unadjusted balance in link branches for payment made for such branch, and margins held and kept in sundry deposits for funded facilities. These 5 items you have to reduce while calculating demand and time liabilities. There are 3 items that has to be included while calculating demand time liabilities. What are those 3 items? Net credit balance in branch adjustment account, borrowings from banks that are abroad. If you have taken any borrowings from the banks within India, you can net it off, but if you have taken any borrowings from banks that are abroad, you cannot net them off. Hope this is clear. And interest accrued but not accounted in books of accounts. These 3 items you have to include while calculating demand and time liabilities. This is regarding CRR, SLR. Next, verification of assets. Audit procedures that has to be followed while verification of assets. Generally we will be dealing with 5 types of assets. First one is cash bank balances and also money at call and short notice. Next one, investments, advances, fixed assets, other assets. These fixed assets and other assets, it is not so important. There I have covered only the important areas, okay, in respect of fixed assets and other assets. Let us see. Audit procedure regarding cash balance. First of all, you have to physically verify the cash balance in the bank, including the cash balance that is present in the ATM, and you have to tally this physical balance of cash with the balance that is being shown in the books of accounts. That will be the simple audit procedure relating to cash balance. Coming to balance with RBI. Generally bank, it will keep some balance with RBI. Now how you have to verify it? You have to verify balance confirmation certificates and reconciliation statements. You have to request for a confirmation certificate from RBI and should also verify the reconciliation statements that has been prepared. Now while reviewing the reconciliation statements, special consideration has to be given to following items. What are those items? Cash transactions that are remained unresponded and revenue items that requiring adjustment and other credit and debit entries remaining unresponded for a period more than 15 days. These 3 items has to be given special consideration while reviewing the bank, while reviewing this reconciliation statement. Okay. Next, balance with other banks. While verifying the balance with other banks, all the procedures that you followed here will be followed here also. Apart from those procedures, see, same procedures as above with RBI. Apart from those, no debit for charges and credit for interest should be outstanding in the account with respect to balance that is present in the other banks. Other banks. And no check sent or received in clearing is outstanding, and examine large transaction to ensure there is no window dressing. And finally, check bills. Check bills checks outstanding as on date or credited subsequently. Okay, as on balance sheet date, if there are any outstanding checks, get evidence regarding whether those checks have been cleared after the balance sheet date or not. Okay, that is subsequent events, you can say. That is audit procedures regarding balance with other banks. Money at call and short notice. Generally these would be interbank loans for a period of 14 days or less than 14 days. Those types of loans will be known as money at call and short notice. Now what should be the audit procedure with regard to money at call and short notice? Generally, while issuing this money at call or short notice, whether the authorization is available to the bank to give such type of loan, that has to be checked. Okay, proper authorization, and whether complied with the instructions that have been issued by the head office and the controlling office with regard to this money at call and short notice, and verify with certificate of borrower and call loan receipts that are available with the bank. Whenever a bank gives money at call or short notice to other bank, that other bank will give a certificate of borrowing. That certificate of borrowing has to be checked by the auditor along with the loan receipts that are available with the bank that has given the call loan, and examine subsequent repayments received. Generally the time period for repayment will be 14 days or less than 14 days. So after the balance sheet date, whether the repayment has been made or not, that has to be examined by the auditor. And do not net off call loans given against the call loans taken. This should be kept in mind. You should not net off the call loans given and call loans taken by the bank, and you should verify the accounting for the interest that has been made in the books of accounts of the bank, whether proper accounting has been made or not. That is regarding money at call and short notice. Coming to the investments, audit procedures for investments. Generally bank, they will be having a policy for making the investments, whether investments have been made as per the applicable policy or not, that has to be checked. Review the investment policy, and the investment functions has to be separated between the staff of the bank, whether such a separation of function is present or not, separation of investment functions. And auditor should physically verify the investment scripts, okay, and obtain confirmation from the depositories and custodians. Depositories like NSDL and CDSL. If the investments made or in shares or any debentures that are in demat form, you should obtain confirmation from the respective depositories. And examine proper classification into held to maturity, held for trade, or available for sale, and shifting thereof, okay, whether the investments have been properly classified into these three categories or not has to be checked by the auditor. And examine valuation, accounting, and income from investments, whether they have been properly valued and accounted, and whether the income from the investments has been recognized properly or not. Now auditor, he will have to give a special certificate related to this investments. While giving that special certificate, what has to be checked? See, special purpose certificate related to investments. Auditor has to check whether the accounting for the investments has been separately made for the investments that are made on their own account and investments that are made on behalf of PMS clients. PMS clients means portfolio management services. If bank is providing any portfolio management services to the clients, the investments that are made on behalf of the clients, PMS clients, should be accounted separately. They should not be clubbed in the books of the bank. And investments that are made on behalf of other constituents, whether accounting for these three categories has been made separately or not, that will be checked by the auditor. And these investments under PMS category is there na, that has to be audited separately by the external auditor. Hope this is clear. Regarding this, the auditor has to give a special certificate whether accounting has been made separately and whether PMS investments have been separately audited by the external auditor. Coming to the advances, there are certain substantive procedures that has to be performed with regard to the advances that are given by the bank. First of all, auditor has to review the correctness of master data. Master data is what is name of the client, what is the type of loan that he has taken, what is his address, what is his gender, what are his contact details, what is the rate of interest. All these will be coming under master data. Auditor has to examine the correctness of this master data. And all accounts of a customer are tagged to a single customer ID. Let's say there is a particular person, he is having a savings bank account in the bank and he has also taken a term loan from the bank, he also taken working capital loan from the bank, and he has also taken a credit card from the bank. Now even though there are four different types of facilities, all those facilities should be tagged to the single customer ID. Hope this is clear. And examine problem accounts not yet slipped into NPA. Okay, if there are any problem accounts, like example is SMA1 and SMA2 category accounts. SMA1 is those accounts which are overdue for a period of 31 days to 60 days, that will be coming under SMA1. SMA2 60 days to 90 days. Okay, these are some problematic assets which have not yet slipped into NPA, but there is a possibility of slipping into NPA. So these accounts has to be specifically verified by the auditor. And examine accounts adversely commented by concurrent auditor, internal auditor, or RBI inspection team. If concurrent auditor or the internal auditors, they have already identified some accounts and adversely commented upon those accounts, the statutory auditor should specifically examine those types of accounts. And examine the accounts which have been restructured during the year. Restructure means altering some terms, okay, increasing or decreasing the rate of interest, or increasing the duration of the loan, that comes under restructuring. If any loan has been restructured, that has to be checked. Next, examine quickly or early mortality accounts. Early mortality accounts means those accounts which have slipped into NPA within a period of 12 months from the date of sanction, that would be known as quick mortality accounts. And completeness and accuracy of interest being charged, whether the interest that has been charged is complete and accurate, that has to be checked. Coming to the recoverability of advances, whether advances that have been given by the bank, whether they are recoverable or not, the recoverability has to be reviewed by the auditor. How the auditor will review? He will first of all see the periodic statements that are submitted by the borrower. He might be submitting some stock statement, debtor statement that he will verify, and latest financial statements that are submitted by the borrower. By this, auditor will come to know the financial position of the borrower, and reports on security inspection and review audit reports of borrower whose credit facilities are beyond cutoff limit that is set by board of directors of the bank. These four has to be reviewed by the auditor in order to examine the recoverability of the advance. Next, classification and provisioning. Generally, the advances, they will be classified into standard assets, substandard assets, doubtful assets, and loss assets. Regarding this, auditor has to verify whether there is a inbuilt system in the CBS of the bank to do this classification. Whether classification through CBS without manual intervention, whether system is automatically making this classification or not, and whether classification is appropriate. Such classification that is made by the system is appropriate as per the circulars that were given by RBI. That has to be checked by the auditor. And whether there is a proper segregation of advances into secured portion and unsecured portion, because based on this only the amount of provision will be determined. And also, auditor has to give more importance to the date of NPA, whether date of NPA has been correctly calculated or not, because based on this date only, this date of NPA only, the amount of provision that has to be made will change, because there are different percentages of provision that has to be made for each class of the asset. So the date on which the asset has become NPA should be carefully examined by the auditor. That is regarding classification and provisioning. Next, moving to regularization near the balance sheet date. Sometimes what happens is, on the date of balance sheet, to regularize the account, the customer, he will deposit the amount into the loan account, and after the balance sheet date, after 2 or 3 days, he will again withdraw the amount. Now this type of transaction is made just to regularize the account as on the balance sheet date, from avoiding it to become NPA. With regard to these, what the auditor has to check is, first of all, you should remember that once the account is regularized, it should not be treated as NPA. So need not be treated as NPA. And the auditor should check whether such a repayment that has been made by the customer is from genuine source or not, whether the funds that have been received by the customer for repayment are from genuine sources or not. That will be verified. And in case if the auditor gets any doubt regarding the if the auditor feels that such account, even though it is regularized as on the balance sheet date, there is an inherent weakness in that account. Okay, if auditor feels so, then such account will be deemed to be NPA. Auditor can classify that account as deemed NPA, and specific care has to be taken in determining date of NPA. Hope this is clear. These points has to be checked by the auditor in case accounts have been regularized near to the balance sheet date. And drawing power calculation. Generally, drawing power calculation, it will be relevant in case of working capital loans. Sanction limit, it will be present, but for every 3 months the drawing power will be keep on changing based on the stock statements that the customer submits. So whether this drawing power has been correctly calculated or not, in this regard, auditor has to first of all check whether guidelines that are formulated by board of directors of the bank have been properly followed in determining the drawing power of the account. So as per the guidelines formulated by board of directors of the bank, and ensure that stock does not cover amount outstanding to creditors. In the stock statement that is produced by the customer, you should check that the creditors has been deducted, the amount that is outstanding to the creditors has to be deducted from the total stock, and also the type of stock that has been purchased on letter of credit or on guarantee should not be included in the stock statement, because that has been purchased on credit basis, so you should not include that for the calculation of drawing power limit. This has to be verified by the auditor in each stock statement that is submitted. And in case of construction business, special care has to be taken such that mobilization advance has been deducted from the stock. Mobilization advance means generally the construction companies, while starting the construction of the project, they will collect a certain advance amount from the customer to begin the project. That advance will be known as mobilization advance. Now from the stock statement, this mobilization advance has to be reduced. Okay, and also in case of construction companies, the work in progress should be calculated properly. Okay, this has to be taken care by the auditor in case of construction companies. And review the stock audit reports. Generally banks, they will conduct a stock audit of the borrowers once in every year. So those stock audit reports has to be reviewed by the auditor. And there are certain special points regarding the drawing power. First one, stock statements for calculation of drawing power should not be older than 3 months. Generally for every 3 months, the customer, he will submit stock statement to the bank. So based on that stock statement, the drawing power has to be reviewed. And limits not reviewed within 180 days from the due date will be considered as NPA. Okay, if the account has the limit of account has not been reviewed within 180 days from the due date, then such account will be treated as NPA. And classification of the account should be done borrower wise but not account wise. Let's say a particular borrower, he is having a term loan, he is having a working capital loan. If term loan has become NPA, then even working capital loan should also be treated as NPA. Hope this is clear. The classification should be borrower wise and not account wise. Next, coming to government guaranteed loans. This is somewhat important. Generally, in case of recognizing income on the loans for which the government has granted guarantee, there is no specific exemption. Okay, you should the general rule that is applicable all other accounts will also be applicable even in this case also. If an account has been classified as NPA, interest income has to be recognized only on cash basis. That is the general rule. Now that general rule will be applicable even if the account has been guaranteed by a government. There is no change in the income recognition of a NPA. So income recognition, if the account has become NPA, recognize interest only on realization basis. There is no change in this rule. And coming to asset classification. Now if the advance has been guaranteed by a state government, then such type of account can be treated as a NPA. Okay, in case account has been guaranteed by central government, in that case you should not treat that particular account as NPA until and unless bank has invoked the guarantee and central government repudiated the guarantee. That means central government rejected to pay the guarantee. It has rejected the guarantee. Okay, until and unless this situation happens, the account that has been guaranteed by the central government should not be treated as NPA. Hope this is clear. This is the special point. And coming to the agricultural advances. Generally in case of agricultural advance, the classification of accounts will be somewhat different. Here classification will be done based on crop season. Okay, not based on that fixed 90 days. If the account is overdue based on crop season, the agricultural advances will be treated as NPAs. Let us see. First of all, NPA norms in accordance with SLB committees, state level banking committees in each state. Generally each state will be having state level banking committees, and those state level banking committees, they will determine the duration of crops. Generally the crops will be of two types. One is long duration crop, one is short duration crop. Short duration crop is crop for a period less than or equal to 1 year, and long duration crop is for period more than 1 year. In case of short duration crop, it will be, the loan will be treated as a NPA if it is overdue for 2 crop seasons, and in case of long duration crop, the loan will be treated as NPA if it is overdue for 1 crop season. Hope this is clear. And ensure these NPA norms should be applicable to all the agricultural advances that are listed in the circular that has been issued on lending to priority sector. Basically, RBI has issued a circular on lending to priority sector. In that circular, it has given a list of agricultural loans. For all those agricultural loans, these norms will be applicable. Okay, and for all other agricultural loans which are not listed in that circular, for those other agricultural loans, the normal general rules regarding classification will be applicable. Hope this is clear. And coming to restructured advances. Restructure means extending the duration of loan or changing the rate of interest. This will be coming under restructure. Generally, for the purpose of restructuring, RBI has prescribed certain guidelines. Okay, it has issued certain circular. So restructuring of the loans has to be done based on the circular. So ensure compliance with RBI circular. And all the types of loans, standard loans, substandard loans, doubtful loans and loss loans, all the types of loans can be restructured. There is no limitation on this. Okay, standard, substandard, doubtful assets can be restructured. Sorry, loss assets, they cannot be restructured. Only these 3 categories of assets can be restructured. And restructuring cannot be made with retrospective effect. Okay, restructuring can be made from the prospective effect only. You cannot give retrospective effect. And on restructuring, if you have restructured a standard asset, then that asset will be downgraded to substandard asset. In case you have restructured substandard asset, that will remain in the same category only. In case you have restructured doubtful asset, that will remain in the same category only. But if you have restructured a standard asset, that will be downgraded to substandard asset. Hope this is clear. And examine the accounts that have been upgraded during the year, and don't upgrade on part recoveries. You can upgrade the account from one classification to another classification only if full amount is recovered. If part amount is recovered, you should not upgrade the account. Hope this is clear. And coming to sale or purchase of NPA. Generally, banks, what they will do is they will sell their NPAs to other banks, or banks will also purchase NPAs from the other banks. So while purchasing or selling NPAs, there are certain guidelines that has to be followed. So in this regard, what the auditor has to check, okay, what should be the audit procedures that the auditor has to perform. First of all, examine the policy that has been laid by board of directors of the bank. Okay, in regard to this selling and purchasing of NPAs, whether the policy that has been laid by board of directors of the bank is followed or not. And in order to sell or purchase the NPA, that particular advance must have been in the state of NPA for at least 2 years. Only those types of NPAs you can sell or purchase. See, must have remained as NPA at least 2 years. And also, while selling the NPA, you should sell the NPA on non-recourse basis. That means all the risks to be transferred to the buyer. In case buyer is not able to recover that amount, the seller is not concerned with it. Okay, that is non-recourse basis, giving all the risk. So without recourse basis, and the sale should always be on cash basis. You should not sell on credit basis. You should sell the NPAs only on cash basis. And don't purchase NPA which it has originally sold. Okay, now let's say bank A, in the first instance it has sold some NPAs to bank B, and later on after some time bank A wanted to purchase the NPAs that were originally sold by bank A to bank B. Okay, again it wants to purchase the same NPAs. This cannot be done because these NPAs were initially sold by bank A itself. So the NPAs which were initially sold by the same bank cannot be purchased back by the same bank. Hope this is clear. And once the NPA has been sold, it has to be removed from the books of the seller bank. Hope this is clear. Coming to non-banking assets acquired in satisfaction of the claims. Whenever bank gives loans, it will take some security against that loans, and if borrower fails to repay the loan, then bank will invoke that security. Bank will take over that asset that has been offered as security. That will be coming under non-banking assets acquired in satisfaction of claims. In this regard, ensure these are held with the intention to dispose. The bank should be holding these type of assets in the books not with intention to use them for itself, but the intention should be to dispose of them as early as possible. And verify documentary evidence regarding this, whether the title of that particular asset is transferred into the name of the bank or not. The title documents has to be verified, and check ownership is vested with the bank or not, and compliance with holding period of such assets. Generally these types of assets can be held by the bank for a period up to maximum of 7 years. Within 7 years it has to dispose of these assets which have been acquired in satisfaction of the claim. And these assets, they have to be recognized in the books of accounts of the bank at lower of net book value of the advance or net realizable value of the asset. Okay, the lower of NRV of the asset or net book value of the advance that has been given by the bank. Lower of these amount has to be recognized in the books of accounts of the bank. Hope this is clear. And coming to capital risk adequacy ratio. Now, what is the formula for calculating capital risk adequacy ratio? Eligible total capital funds divided by risk weighted assets and off balance sheet items multiplied by 100, and minimum CRR should be 9%. And there is a concept of stress testing. Basically this is a type of test that is designed to determine whether the bank's capital is sufficient to face the adverse economic conditions, whether the bank is capable of facing the adverse economic conditions in the economy or not. This will be tested in the stress testing. Coming to audit procedures, let's see this Basel III framework. Basically this Basel III framework, it aims at improving banking sector's ability to absorb shocks from financial and economic stress. Okay, Basel III framework, it mainly focuses on increasing the capability of the bank to face the adverse economic scenarios, and also it focuses on improving risk management and governance practices within the bank, and it will also strengthen the bank's transparency and disclosure standards. These three are the objectives of Basel III framework. And coming to the audit procedures regarding CASA, current accounts and saving accounts. First of all, auditor has to see while opening the account whether proper KYC norms have been followed or not. Verify adherence to KYC norms, and whether the interest has been properly calculated or not. In case of current accounts, there will be no interest. In case of savings account, whether the interest is properly calculated or not, that has to be checked. And in case there are no transactions in the account for a period of 2 years, then such type of account should be treated as inoperative account. Okay, inoperative account. And in case inoperative account has been revived suddenly, then after revival, if there is significant decrease in the balance of that account, the auditor has to check whether there are sufficient authorization for withdrawal of amount from such account which has been revived. Hope this is clear. Those audit procedures auditor has to perform in case of current and savings accounts. Coming to bills payables. In case of bills payables, auditor has to verify certain internal controls. See, evaluate internal controls over bills payable, such as whether standard formats are being maintained for these bills payable. Okay, standard formats of drafts, mail transfers and traveler checks are being maintained or not, and the unused forms are kept in the proper custody of the officer or not. Even this has to be checked. Unused forms should be under the custody of responsible officer, and there should be reliable private codes which should be known only to the officers of the bank. Hope this is clear. And signatures on demand draft to be checked with specimen signature book that is present with the bank. And once TT, or TT means telegraphic transfer, or DD is issued, immediately give advice to the concerned bank on which it is drawn. Okay, once the bank issues a DD or TT to the customer, the advice that we have issued a DD drawing on your name has to be given to the respective branch, and once that respective branch makes payment to the customer, the paying bank shall send advice to the originating bank. The paying bank, after making the payment, it should send advice that we have made the payment. Hope this is clear. Coming to contingent liabilities, what could be various types of contingent liabilities in regard to a banking company? First of all, claims against the bank but which have not been acknowledged as debt by the bank. That will be the first example for a contingent liabilities. And liability for partly paid investment, like calls not yet made in case of share capital, that would be partly paid investment. And liability for outstanding forward exchange and derivative contracts. Generally these will take place in case of foreign currency transactions. And guarantees given on behalf of constituents, means guarantees be given on behalf of clients. And acceptance, endorsement and other obligations, other items for which bank is contingently liable. These are various types of contingent liabilities. And in regard to this contingent liabilities, bank, the auditor has to obtain management representation from the management of the bank. Now what should be present in that management representation regarding these contingent liabilities? First of all off balance sheet items are accounted in the books of accounts. Auditor has to get a management representation stating that management has accounted all the off balance sheet items in the books of accounts, and all off balance sheet items are supported by respective documents and they have been properly disclosed under the head of contingent liabilities. Basically contingent liabilities, they will not be recognized in the financial statements, they will be given in the disclosures in the notes to the accounts. And disclosed contingent liabilities does not include crystallized liabilities. Once the contingent liability crystallizes, you have to transfer it to the liabilities. So you should make sure, the auditor should make sure that the amounts that are included in the contingent liabilities have not crystallized. And estimations of financial effect is based on AS 29 contingent liabilities, and include management's justification of not disclosing contingent liabilities whose possibility of outcome is remote. Management might sometimes not disclose some contingent liabilities due to the reason that the probability of that contingent liability becoming crystallization is remote. In those cases, management has to provide its justification for such a decision. Okay, these are certain management representation that has to be taken by the auditor in case of contingent liabilities. And what are the audit procedures regarding contingent liabilities? First of all, auditor has to ensure that non-fund facilities are given only to the regular customers of the bank. In case non-fund facilities like guarantees are given to non-regular customers, then auditor has to verify creditworthiness of that particular customer. Okay, ensure non-fund facilities are given only to the constituents. If not, inquire the financial position and creditworthiness of those customers. And there should be adequate internal controls that should be present while giving these guarantees. And overseas supplier is paid based on shipping documents Okay, when you are paying any overseas supplier on behalf of the customer, you should have to make that remittance only based on the shipping documents that are submitted by the customer, and ascertain adequacy of accounting system, whether accounting system is properly recording all the contingent liabilities or not, because if you don't record the contingent liabilities, they will be missed. Okay, you have to disclose the contingent liabilities in the balance sheet, in the financial statements. If you want to disclose them, first of all you should record them in the books. Okay, and test completeness of recorded obligations, whether all the obligations have been recorded completely or there are any missed obligations. That has to be verified by the auditor. And claims against bank not acknowledged as debt, with regard to this specific contingent liability, what are the audit procedures that has to be performed by the auditor? First of all, auditor will have to examine the relevant audit evidence regarding this claim made by such third party, and review meetings of the review minutes of the meetings to determine whether there are any claims which the bank has not accepted, and ascertain status of outstanding claims from the management. What is the status of those outstanding claims as of now? This has to be inquired with the management, and review subsequent events provides evidence about valuation and completeness. As on the balance sheet date, if there are any claims which the bank has not accepted as a debt, then auditor has to subsequently verify whether in subsequent date the management has accepted them as a debt. In case management has accepted it as a debt, what is the valuation of that particular debt? So if he verifies those subsequent transactions, he will get evidence of the contingent liabilities as on the balance sheet date. Hope this is clear. And guarantees given on behalf of constituents. This is another type of contingent liability. Okay, here we have discussed various types of contingent liabilities now. So this is the fourth type of contingent liability. With respect to that, what are the audit procedures that the auditor has to perform? First of all, auditor has to see whether there are proper internal controls with regard to issue of guarantees, adequate internal control over the issuance of guarantees, and whether there are proper internal controls to safely keep the unissued guarantee forms. Internal controls over unused guarantee forms. Unused guarantee forms must be safely kept with the proper officer, and examine register to see whether expired guarantees have been written off, striked off. Once the guarantee period expires, that particular guarantee has to be striked off from the register of guarantees, and ensure all guarantees are disclosed in the financial statements. There is no guarantee that is missing, and verify guarantees with letter of guarantee issued by the bank. While giving the guarantee, the bank will give a letter of guarantee to that particular customer. So the auditor has to check the same, and counter guarantee received from the customer. Okay, and verify securities held as margin for the purpose of giving the guarantee. Sometimes, not sometimes, most of the times, bank will take some security from the customer. Okay, that has to be verified. And if claim arose, check whether the proper provision has been made as per AS 29. Okay, so that is regarding guarantees. Coming to bills for collection. In case of bills for collection, the auditor has to first of all ensure bills drawn on other branches are not included. In the same bank, one branch of the bank has drawn a bill on other branch. Now these types of bills should be excluded while consolidating the balance sheet of the bank, because these two branches, they belong to same bank only, so they should not be included in the bills for collection. Next, verify outward bills with register maintained. Generally, sometimes what happens is, this example I have already told you. There is branch 1, there is branch 2. Now branch 1 received a bill for collection. Let's say it is in Kurnool. Okay, this example I have already told you now. And branch B, branch 2, it is in Chennai. Now from a customer, branch 1 has received a bill for collection, and the customer from whom this bill has to be collected is present in Chennai. So what the branch 1 will do, it will transfer this bill to the branch 2, and branch 1 will record this bill as outward bill for collection, and branch 2 will record this bill as inward bill for collection. Now what he says, verify outward bills with the register maintained. Now the branch 1, it will maintain a register. In this register, it will note down the outward bill that is sent to the other branch, that has to be verified by the auditor, and examine collections subsequent to the balance sheet date. As on the balance sheet date, if there are any bills for collection pending, auditor has to examine whether these bills have been subsequently collected after the balance sheet date or not, and examine procedure for crediting the party. Once the bill has been collected, what is the procedure that is being followed by the bank to give credit to the customer, and examine controls that are existing to debit the customer for commission. Okay, once you have credited the customer for the bill amount that is collected, you should also charge your commission income from the customer for collecting the bill. So how the bank, now what is the procedure that is present in the bank in order to debit the customer account for the commission, and no income has to be accrued with respect to the bills until and unless it has been collected. Hope this is clear. That is regarding bills for collection. And coming to audit report of bank shall contain following items. The audit report that the auditor issues to the bank should contain following items. First of all, the audit report should state that balance sheet shows true and fair view, profit and loss shows true balance, and all the information and explanation that the auditor has asked is whether given by the management or not, whether the information has been provided to the auditor or not, that has to be specified in the audit report, and whether transaction of bank are within the powers that are granted to the bank or not, whether the bank is entering into any transactions that are beyond its powers, that has to be specified in the audit report, and whether returns received from branches are adequate for the purpose of work of the auditor, and any other matter which auditor considers to be brought to the notice of central government, even that matter he can disclose it in the audit report. And coming to the long form audit report, in case of banks, apart from giving audit report, the general audit report, there will be a long form audit report that has to be given by the auditor. Now generally, as you all know, in case of banks, there will be statutory branch auditor SBA, and there will be statutory central auditor SCA. Now this long form audit report, it will be prepared by each branch auditor, and he will send this long form audit report to the statutory central auditor. So to be given by SBA branch auditor and statutory central auditor also. Okay, all these long form audit reports which were submitted by the branch auditors to the central auditor will be combined by the central auditor. Hope this is clear. And SBA gives LFIR to statutory central auditor, and he consolidates at the bank level. Okay, statutory central auditor will take all these branch LFIRs and he will consolidate them at the bank level. After consolidating them, what the central auditor he will do, he will place it before the management. Central auditor will submit LFIR to the management. Now management, it will place this LFIR before the audit committee of the board with action taken or proposed to be taken. Based on the recommendations that are present in the LFIR, the management will take the action or will propose the actions that has to be taken, and it will place this LFIR along with the action taken report ATR or proposed to be taken report before audit committee of the board. And finally, this LFIR has to be submitted to the RBI within 60 days from the date on which LFIR is submitted by the statutory central auditor. Okay, within 60 days from the date of submission by auditor. Hope this is clear. This is the story regarding long form audit report. And coming to the types of reports and certificates. In case of bank audit, apart from audit report, there is obligation on the auditor to give certain other types of certificates and audit reports. What are those other types of certificates? First one, report on internal financial control over financial reporting, and LFIR report, LFIR and report on SLR requirements, that is statutory liquidity ratio, whether bank is properly maintaining this SLR is or not, that has to be reported. With regard to that, a certificate has to be given by the auditor. And report on treasury operations, certificate on reconciliation of securities, asset liability management, certificate on interest subsidies and interest subventions. Generally, in case of agricultural loans and education loans, there will be some interest subvention. That means the government will reimburse a certain portion of interest on these loans. Even in case of home loans also, there will be interest subvention. Regarding this, the auditor has to give a certificate. And certificate on corporate governance for listed banks, this will be given as per the SEBI LODR regulations. And authentication of CRR, okay, capital risk adequacy ratio and other ratios reported in the notes, whether those ratios have been properly calculated or not. And report on Ghosh and Gilani committee recommendations. Okay, regarding these certificates has to be given by the auditor. And coming to the concurrent audit. Concurrent audit is related to verification of daily transactions of the bank. Now, what will be covered in the scope of this concurrent audit? Generally, cash, deposits, advances, investments, foreign exchange, housekeeping and other items will be covered. All relating to these items, the points which we have discussed earlier, the same points you can write here also. But there is one particular item, foreign exchange transactions, which I will be explaining. First of all, with regard to foreign exchange transaction, the concurrent auditor has to perform following procedures. He has to check foreign bills negotiated under letter of credit and check FCNR, okay, foreign currency non-resident accounts to see debits and credits are permissible under the rules. Basically, there will be FEMA rules that will be applicable. Okay, whether the debits and credits that are made to this account as per the permissible limits or not, and proper accounting of inward and outward remittances has been made or not. Okay, accounting has been made or not, and ensure balances in nostro accounts are within the limits, and ensure verification and reconciliation of nostro and vostro account transactions, ensure adherence to guidelines issued by RBI and head office. These specific procedures has to be performed by the auditor, concurrent auditor. And appointment of concurrent auditor. Generally, the decision of whom to appoint as a concurrent auditor, okay, whether there should be a in-house department who will be performing concurrent audit, or some external people has to be appointed as a concurrent auditor, is left to the bank itself. So, decision of own staff or external auditors is left to the discretion of individual banks, and the tenure of the concurrent auditor will be decided by ACB, audit committee of the board of the bank, and generally this tenure should not be more than 5 years. And also, the concurrent auditor should not be associated with the bank with one particular branch for a period of more than 3 years. The maximum period for which a concurrent auditor can audit a branch is for 3 years. Okay, do not continue with same branch for more than 3 years. And terms of appointment and remuneration of this concurrent auditor, it will be fixed by audit committee of the board. Coming to the reporting aspect, generally this concurrent auditor, he has to give concurrent audit report on a monthly basis, and during this reporting, if he finds report serious irregularities to the controlling office or the head office during the audit, if he finds any serious irregularities, he has to immediately report them to the head office and also to the controlling offices. And quarterly and annual zone wise report has to be submitted to the audit committee of the board. And during the audit, if the concurrent auditor finds any fraudulent transactions report fraudulent transactions immediately to inspection and audit department, and also to chief vigilance officer, and also to branch manager. Okay, you have to intimate to the branch manager regarding fraudulent transaction only if branch manager is not associated with that fraud. Okay, if branch manager is also associated with that fraud, you should not intimate it to the branch manager. Hope this is clear. So by this we have completed revision of bank audit, and yes, the length of this chapter is somewhat huge. You have to revise this chapter as many times as possible in order to remember these points, otherwise you will not be able to remember them. And I would also suggest you to go through these chapter only after completing all the chapters. Okay, so yes, we will be meeting in the next class with a revision of a new chapter. And if you wanted to purchase the classes, you can visit our website lecturepedia.in and you can place your order. Okay, take care, bye bye.